Hello everybody and welcome to another video focused on short-term funding. This time we're going to talk about the short-term funding alternatives available to financial institutions. Specifically, the previous one was on the alternatives available for corporates, non-financial institutions, this time financial institutions, because that is a very sort of specific, indeed, a very specific topic. So if you think about a bank, how does a bank fund itself, fund its assets, at least in the short term? Well, there are going to be a few alternatives that we will be exploring here. First of all, we'll talk about a very obvious one, that's deposits coming from clients. The second one is going to be funding in the interbank market. That is via short-term loans taken from other financial institutions, essentially other banks, potentially also the central bank. And the final one is going to be issuing commercial paper. So commercial paper, the same kind of thing that we talked about before with corporates, except that in the commercial paper segment, that is short-term debt securities issued by companies, i.e. not government, financial institutions do indeed pretty much dominate. And here we'll talk about both the classic commercial paper, unsecured, as well as the secured version or asset-backed commercial paper as well. So quite a few things to talk about here. Let's make a start with the first one, that's deposits. So what you need to know about deposits, although I guess everybody knows a thing or two about deposits, because most of us, I guess pretty much all of us, have bank accounts and we are depositors at banks. We deposit money at banks. Well, this is absolutely the primary short-term or source of short-term funding for financial institutions, source of when I write S/T, that's going to mean short-term. I don't want to write short-term all the time, the full phrase, funding. And when you think about what types of accounts you've got at a bank, typically, most clients will have what's known as a current account, although your book describes this as a checking account. Okay, if you're used to the term current account, checking account means the same thing. That's our day-to-day go-to account where we receive our remuneration, our salaries or wages, from which we make our day-to-day payments. So this is an account. A checking account, this kind of account, this one. What's characteristic for it is that it has no stated maturity. You just have money coming in, money going out. Nobody expects you to necessarily hold it for a specific amount of time or period of time, and it's going to be used, or the money there, or that account, used for our day-to-day transactional purposes. Typically, as a client, you don't receive a lot of interest on the money, on the balances on that checking account, so pay very little, or indeed no interest. And what is more, the money on that account, funds, may be withdrawn at any time. That's especially true of clients held by, of accounts held by retail clients, individual clients. However, typically the accounts of corporate clients are not, or the money on those accounts is not withdrawn sort of on a day-to-day, from one day to another, the money disappears. Typically banks can count on that being somewhat more stable in the sense that corporates typically behave in a more predictable way or stable way, and they don't just withdraw all the money out of their accounts without giving fair warning. Anyway, relationships are built with these corporate clients, which also allow for a degree of predictability in terms of their behavior. So that's going to be our first type of account. The second one is, I guess, something a lot of you are used to also having, is a savings account or a savings deposit, let's say account. The naming in the curriculum is not necessarily what you and I may encounter in your day-to-day life, but savings deposit means a savings account. This is where you as a client will hold money, but it's not going to be money or an account that you use for transactional purposes. So you hold the funds there. These are held for non-transactional purposes. The bank will typically pay you higher interest than on a normal checking or current account. But in return, they expect a bit more predictability in terms of your behavior. You will often have certain limits with regard to, for example, how many withdrawals you can do from your savings account. So money is supposed to be more stable there. Money is supposed to be kept there in a more predictable fashion. So you hold money there that you can really use for saving instead of transactional purposes. And quite often there will be some stated term for these accounts. However, if that is the case, we would probably be talking about a specific type of deposit known as a certificate of deposit, which I want to explore. So let me say over here, if this is the case, we are really moving more into the certificate of deposit, something known as the CD, the certificate of deposit. This is, for retail clients, this is typically the ability to open up a term deposit where you tell the bank, I'm going to keep the money in this deposit account for, let's say, 3 months or 6 months, and you get interest that is higher than on the other savings account or checking account in return, but you have to keep the money there for that specific amount of time, and the interest will be added to your account balance at the end of the term. So that's what we mean by certificates of deposit. However, in the context of how your CFA curriculum describes this is kind of aimed more at the bigger clients, especially corporate clients who may use this form. So certificates of deposit will typically have maturities of less than 1 year. Okay, so short term, definitely, funds kept at banks, and they will also typically pay all of the interest which accrues kind of over their life at maturity, meaning that it's only by holding those funds in the CD until the very end do you get the interest being added to the balance. However, what you may be absolutely tested on in a theoretical question context is the fact that these CDs may come into variants, into versions. One is going to be the so-called non-negotiable CDs, certificates of deposits, and the other is going to be negotiable. So this one is very strict in the non-negotiable one. If you're ever having trouble, I'm having trouble pronouncing this, but if you're having trouble differentiating or remembering which one is which, remember the non-negotiable one is the stricter version. This one pays the principal, so the amount initially deposited, right? Principal means the amount you initially put into this deposit, plus the interest that accrues on it over its term. Obviously, on maturity, but only to the initial depositor of the money, only to the initial original depositor. And you kind of may think, well, that's normally what happens. It's only the person who put the money into an account who can get it out. But the initial depositor in the other version, the negotiable one, you'll be able to transfer that to somebody else, which is definitely less strict. It gives you more access to potential liquidity. So to the initial depositor, and there's going to be a penalty for any early withdrawal. So if you take the cash out, there's going to be a penalty. Now, whether that penalty comes in the form of an extra charge or perhaps losing the interest that would have accrued completely or not completely, that's a different thing. There is an element of penalty in non-negotiable CDs. The other version of this is something called the negotiable CDs. So that's the second type of negotiable CDs, and those will definitely be more flexible. So what may happen is that the depositor, that original depositor of the money may access the funds that have been deposited without suffering some kind of penalty, but you don't go to the bank to get your original money out plus some interest. Here, the original depositor may access the funds by actually selling the CD, by selling the certificate of deposit to somebody else in the open market. So this will trade like some security that is in fact issued by the bank, and this will you'll sell the CD in the open market before obviously its maturity date. So these CDs, when when they mature, how much money should be received at the end, and if you don't want to wait until that time, you may sell the CD in the open market just like you would any other debt instrument. So these CDs, which are in fact, that looked like a CDS and I wanted to say CDs, certificates of deposit, will be issued by banks, and they come in the variety, not just non-negotiable and negotiable, but there's also talk in your curriculum of those which come with a small denomination. So small denomination certificates of deposits, which are aimed primarily at the retail market, individual clients, or perhaps smaller businesses. And there's also large denomination CDs, those quite naturally being aimed at the corporate or wholesale segment of the market. These may be purchased by money market funds, so funds specializing in short-term debt securities, where here the issuer is a bank, promising to give back something at the end of the instrument's life at the maturity date. These may be aimed at corporates who want to save money, invest money in these things, but want the ability to be able to exit if they can't wait until the official maturity date and need or require the liquidity. They may be aimed at anybody who's larger because of their larger size and the larger amount, simply. Okay, so these are all the different types of deposits that you need to know about. We've covered these. Let us now move on to the so-called interbank market. Okay, the interbank market is the market where financial institutions, specifically banks, borrow and lend money to and from each other. Now, a lot of the time, what happens here, or most of the time, actually I shouldn't say most, a lot of the time suffices, is unsecured. lending and borrowing between financial institutions. Now, because we're talking about short-term funding alternatives, you should appreciate that most of this lending and borrowing happens indeed for periods of below 1 year or maximum of 1 year. In fact, in reality, the majority of the money that is lent and borrowed by banks comes in the form of something called overnight lending or borrowing. So that is borrowing until the next day. Okay, it can reach a maximum of 1 year, but to be honest, it's quite typical to see banks borrowing a lot of funds until the next day. The reason for this is quite specific because, why do banks need to borrow money? Very often they need to borrow money because their clients, customers, so depositors essentially, want to do transactions. We want to, transfer money somewhere else, maybe because we're doing a purchase of something, or maybe we're switching banks. I don't know, for whatever reason we need to pay. Or maybe if you're a corporate client, you need to pay wages to your employees, or you need to pay your suppliers. And as a result of what we as clients do, banks need to settle with the other institutions and pay them the money that we are sending from their accounts. And banks as a matter of fact, don't have that much liquidity because most of the money that we have given to the bank gets invested into loans, or maybe banks hold longer term bonds and securities, etc. So sometimes banks find it tough to settle with the other institutions, in which case they borrow money from one another just to make up for the shortfall, so to speak. And because you never know what's going to happen next day, it's quite natural. You never know how your clients will essentially be behaving the next day, whether that maybe has money will be flowing into the bank or once again flowing out. It's quite a normal thing between banks to borrow until the next day, and the next day we'll see what happens next. And perhaps the situation will offset itself naturally because more money will be coming from other banks to this bank. Or if the situation persists and money is sort of being transferred out, again, we will roll the previous day's debt and borrow more, obviously providing the other institutions are willing to lend to us. Now, I've gone well and beyond what your book discusses here, but I used to work in a bank, so this is something I feel ought to be explained because many people do not. Who do not maybe have a background in banking will not necessarily appreciate or understand, and I think it helps to understand this. Now, most of this borrowing between banks is going to be, the borrowing rate is going to be in some way tied to the MRR, the market reference rate. In fact, a lot of market rates are actually often the other way around. And sorry to be correcting what your curriculum says, but in reality, market reference rates, things like the Euribor in the Eurozone, for example, they are calculated based on what the banks do, not the other way around. It's not that the banks lend and borrow to each other in a way that's connected to Euribor. Euribor is a function of what the what's happening in the interbank markets. However, please bear in mind that there has to be a factoring in of credit risk. So when banks lend to each other, they don't completely trust each other and say, just take this money at the reference rate. There is always an add-on potentially for credit risk. So let me do a but. Credit risk is factored in. So if you think somebody poses a bigger credit risk, lending to them is more risky, then you'll obviously add a bit of a margin or a spread above the market reference rate. Is factored, but credit risk factored, I wrote factored risk, no, factored in, so included in the rate. Plus, banks, once again, don't trust each other without any limits. They will have so-called counterparty limits up to which they are happy or okay to lend on an unsecured basis to a specific other financial institution. Once you've lent up to that credit limit and that institution wants to borrow more, you will not necessarily lend to them on an unsecured basis anymore. You'll want to have some kind of backing in the form of collateral. Now, a very specific thing is that let's say this is Bank A. And once again, here I'm telling you a little bit more than what is in the book, in the curriculum, because your book just says a few things about this and expects you to understand, which I think is going to be difficult if you haven't ever seen a bank work from inside. If I'm Bank A and my client over here is is doing a transfer of money, let's say to Bank B, where they've got another account, or maybe somebody else has an account, whatever. What will happen is we will often settle, Bank A and Bank B will settle because each one of them has an account. Both Bank A and Bank B have accounts opened at the central bank. Be that the European Central Bank or the Bank of England or whatever central bank institution, wherever, or the Federal Reserve in the United States or wherever else you are. So each one will have its own account at the central bank. And in many countries, these accounts are used for settlements between banks, which result from transactions done by banks between institutions in the banking system. However, each one of these accounts will hold a certain amount of money, and you could think, okay, so if your client does a transfer, then as a follow-through, Bank A should transfer money to Bank B using these settlement accounts. But watch out, central banks will impose certain minimum amounts which you have to hold on the account there. This is called minimum reserve requirements, and we're not going to go into the details of how this is computed. It's actually a function of the deposits which a bank has, but the idea is everybody has to have an account at the central bank, but not just have an account with a specific balance as a minimum in it. So central banks force you to have as a minimum a certain amount of money, and the bigger a bank you are, the more money you should hold on that reserve as a minimum reserve at the central bank. And sometimes, if you indeed transferred money to other institutions, to Bank B and some other banks as well, that may cause you to drop below the minimum level, which you don't necessarily want to do. So you'll have to indeed, in the interbank market, borrow money from others to make sure that your account at the central bank holds enough funds to meet the minimum reserve requirements. So over here, because, let's say, of minimum reserve requirements, that is a requirement by the central bank to hold a certain minimum amount on our accounts at the central bank. Obviously, commercial banks' accounts at the central bank. Because of this, banks often borrow and lend money, and this lend to each other. And because this happens using the accounts which they all hold at the central bank, we call this, and this is especially a very American thing, right? This is the borrowing or lending of central bank funds. So the borrowing or lending of money which banks have on their accounts at the central bank is the borrowing of central bank funds. And what we can compute and what we are often shown is the central bank funds rate. And that's the rate at which on a given day central bank funds are indeed borrowed or lent. But don't confuse this with the rate at which you can borrow money from the central bank. No, this is the rate at which banks agree, oh, you've got a bit of a shortfall, I've got a bit of an excess on my central bank account, meaning you are under threat of dropping below the minimum reserve requirement. I've got an excess. Why don't you borrow money from me? Why don't I lend you money from my account to your account? But because we're lending and borrowing money in between accounts held in the central bank system, this is called the lending and borrowing of central bank funds. And the rate agreed between the institutions, this is negotiated between the individual banks, is called the central bank funds rate. This is going to be very much influenced by the monetary policy, which is conducted by a given central bank. And in the economics section of the curriculum, you learn more about this. Let's also say, but only as a bit of a phrase here, as a bit of slogan, also influenced by so-called open market operations, open market ops. This influences influenced by the central bank funds rate, is influenced by monetary policy conducted by the central bank and open market operations. And I'm not going to necessarily go into the details of this here. More will come on this in the economics sections. However, what if a bank, imagine the clients of a bank are transferring money elsewhere to other institutions, and therefore that bank account with the money that it has at the central bank needs to send that money from its account to other institutions in order to settle those transactions. And it's under threat of dropping below this minimum reserve requirement level. And if a bank is unable to top its account up with money borrowed from others in the interbank market, so if a bank is unable to borrow in the interbank market, that is from others. So what we discussed here, the interbank market, this is all the interbank market, where banks agree to borrow and lend to one another, and it typically happens using the accounts held at the central bank. So we're talking about the lending and borrowing of central bank funds, money kept at the central bank. If you're unable to do this, why? Because I guess maybe nobody trusts you anymore. You've borrowed too much. You've reached their limits, their counterparty limits. Or maybe the situation is severe that it's not just that they don't trust you, they don't trust anybody, right? Nobody trusts one another because we're in some kind of crisis, and banks have lost faith in one another's situation. Then typically you will go to the central bank itself, because the central bank in most economies has or plays the role or has a function which is often called the lender of last resort. If you can't borrow from anybody in the interbank market, you'll typically turn to the central bank. So you may indeed borrow from the central bank itself. However, watch out, because this is going to happen at a much higher, or at least somewhat higher rate than borrowing in the interbank market. So using more or less American terminology here, if you're not based in the US, I'll show you how this is called. In America, this is called discount window lending. Or indeed lending by the central bank, borrowing by a commercial financial institution. So using the central bank's discount window means you borrow money from the central bank instead of borrowing it from somebody else in the interbank market, another financial institution. And this type of borrowing typically requires collateral. The central bank will not lend to you without you supplying some form of security, so collateral. And this is, the really important thing is, this is typically done at a higher interest rate. So if you have to turn to the central bank, not only do you have to provide collateral to back the transaction up or secure it, you'll also have to pay a higher cost of it. It's typically done at a higher rate than high interest rates, then the central bank funds rate. Remember, this is not the rate at which you borrow from the central bank, but this is the rate at which commercial financial institutions lend and borrow to one another the money that they have on their accounts at the central bank. So the central bank funds rate, okay, higher than. Now, all of this is very much so basically meaning that this is more expensive. Now, let me show you a distinctly non-American example of this. I'm going to fire up Google over here on my in my browser, and I will go to the central bank website, but it's going to be the central bank of in the Eurozone. That's the ECB, the European Central Bank. So let me type in the address ecb.eu, and let me try to prove this. This is the President of the European Central Bank, Christine Lagarde, and very recently, in relation to when I'm recording this, literally 2 days ago, I'm recording this on the 14th of June, 2024, and since the 12th of June, so 2 days ago, we've got a new set of rates in the Eurozone or in the European Central Bank. And look, the first of these interest rates is called the marginal lending facility, 4.5%. And if you need to borrow from the central bank, you will right now face at the ECB an interest rate of 4.5% for borrowing directly from the ECB. Plus, this requires collateral. If you're not convinced, look somewhere over here. I just don't know. Let me check where it is. Over here. There is a section called collateral, and I think, wait a second, let me go back one step. Once again, press this monetary policy and markets, scroll like this over here, and will we get something? I don't know. But the Eurozone system means there is a whole database of collateral which you can supply to the ECB if you want to borrow money from them, but borrowing money from them requires collateral. Okay, look here, it's written, if I go like this, when banks borrow from us, i.e. directly from the ECB, European Central Bank, they have to provide adequate collateral as security. And you can obviously look up which securities are acceptable as collateral. They are generally different types of bonds, which the ECB accepts as collateral. And last time I looked, there was more than 30,000 different issues of bonds acceptable as collateral. Nevertheless, it costs 4.5% to borrow money directly from the ECB right now, and you have to supply collateral. So what's the alternative? Well, the alternative is to borrow in the so-called interbank market. And what the ECB publishes is something called the Euro short-term rate. Let me click on this. Every day, now I'm recording this on the 14th of June, so as you can see, that's the date at the top of this table or this computation. Last update, 14th of June, 8 a.m. And it shows you 3.661. Now, this is calculated based on 678 transactions, which happened between 35 banks, and it happened on the day before, the 13th of June. So basically, on the 13th of June, which happened to be a Thursday, 35 of the biggest banks operating in the Eurozone borrowed and lent money to one another in 678 distinct transactions. So this is a thing that goes on quite a lot. And by the way, all of these transactions taken into account were overnight transactions. So this was borrowing or lending until the next day, effectively. And the average from those 678 transactions, the average interest rate at which the borrowing was done was in fact 3.661. So this would be the equivalent of the central bank funds rate, the rate at which banks actually lent and borrowed money to each other from and to their central bank accounts. And that was yesterday 3.661% on the 13th of June, whereas if you wanted to borrow directly from the ECB, which you would only do if you were desperate enough to go for it, typically because the other banks wouldn't want to lend to you. That's why you would turn to the ECB. It was 4.5%. So you can see how that is clearly higher. I just think it's nice to sometimes, see this stuff firsthand based on real life examples. And I'm sure wherever you are, you can go and do similar checks at your central bank, because central banks typically show you what's the average rate at which banks were actually borrowing money from one another. These rates will be called different things. For example, in the UK, this is called the SONIA, the Sterling Overnight Index Average. Where I come from in Poland, it's called the Polonia rate, the Polish overnight index average, a computation based on actual transactions done by banks for very short-term lending borrowing overnight, but based on real conditions in the market. And very rarely do you borrow money from the central bank because it's simply more expensive and it requires collateral, whereas these short-term loans between banks themselves are typically unsecured. If you start borrowing money from the central bank, that is indeed going to be a sign of weakness, right? It means others don't want to lend to you. So this itself may not just be limited to the borrowing of the money. This may also cause a bank that uses this facility, may cause the bank to be subject to a higher level of scrutiny, a higher level of oversight, basically, from the central bank, because they'll see, hey, you're in trouble, so that's why you've had to come and borrow from us. You wouldn't need to borrow from us if you were not in trouble. So, that's what happens. And let's just add, but we will have a separate video on this, that borrowing in the interbank market can also happen in a secured way. So secured borrowing stroke lending also possible, and it's absolutely, it happens all the time. But we do it using a transaction called the repo, typically. Use this construct, and we'll have a separate video. The next video is on the repo or repurchase agreements dedicated to it. It's quite a big topic. Now, enough on the interbank market. Let's move on to the third form in which banks get short-term funding. Remember, this is what we're talking about all the time here. So the third alternative for financial institutions is to issue something called commercial paper. Just like companies may issue commercial paper, which is sort of short-term debt securities, short-term, well, you could say short-term bonds, although technically bonds are not short-term, bonds are longer-term. This is going to be most of the time unsecured, and it's absolutely used to satisfy or to meet the short-term borrowing needs of banks, especially banks. And your book says, I'm not sure where the statistic comes from, that more or less, but it's an interesting one, I think. 60% of all commercial paper issuance comes from financial institutions, even though commercial paper may be issued by pretty much anybody, not just banks, not just financial institutions, but non-financial companies as well. Most of this, around 60%, comes from financial institutions. The remainder, so I guess that would be 40%, issued by non-financials. You may get a question on, who issues the most, a theoretical one, and now we'll know that it is financial institutions. Definitely corporates issue more of the longer term securities. Financial institutions issue more of the shorter term securities. Now, a very specific type of commercial paper is going to be, well, I'm not sure if I need the brackets here. I had unsecured, but let's have the second version of this. If something can be unsecured, it can also typically be secured. So secured commercial paper, secured CP. Remember, CP is always the abbreviation for commercial paper. And this comes in the form of something that looks like the alphabet. A, B, C. Now we're not going to have D, A, B, C, P. This is asset-backed commercial paper. Now we will be talking about asset-backed securities later on in the fixed income section of the curriculum in quite a lot of detail. But here, at this relatively early stage, you already have to know about something called ABCP, or asset-backed commercial paper. So this is a type of debt security, which of course is asset-backed, meaning that the interest and principal payments on the commercial paper will come from cash flows generated by specific assets, by designated assets, which the bank has. In the case of banking, this will typically be loans or other receivables that banks have. When a bank makes loans, clients are supposed to repay those loans. And the idea is, as your clients are repaying the loans, i.e. as loans are generating the cash inflows for a bank, those cash flows will be used to make payments of interest and principal to those who hold these asset-backed commercial paper securities. Other receivables are also possible. You can have things backed by not just a loan portfolio, but receivables from credit cards, auto loans, that is loans to buy vehicles, especially popular in America, student loans, etc., etc. So your book, your curriculum, just talks briefly about how this kind of thing gets constructed. So over here you've got a bank, let's say, and the bank has some loans on its portfolio that it made. Now, let's imagine they are short-term loans. So these could be, for example, loans made via credit cards. And as you know, credit cards are supposed to be repaid relatively quickly within a specific period of time, although not all people do indeed repay. So what the bank does is the bank will sell these loans, sells the short-term loans to a special purpose entity, an SPE. That is a specifically set up company for that purpose, right? To buy the loans from the bank. And it's this SPE that will pay money to the bank, pays dollars or euros, basically pays cash to the bank. So the bank gets the money from the sale, and it has fresh cash that it now has fresh cash, which may be used to, I guess, perhaps make more loans or make more loans via credit cards, etc., etc. However, what's the purpose of this SPE? So this was step one, so to speak. But the second step now is that the SPE, this special purpose entity, sometimes also referred to as the SPV, that special purpose vehicle, now issues asset-backed commercial paper to investors. So you get some investors on board who, oops, that's the wrong color, apologies, or wrong pen here, get asset-backed commercial paper issued by the SPE or SPV, and in return, obviously, these guys pay money euros or dollars, which is actually how the SPE has money to pay to the bank for those receivables. And now, what the investors receive as cash flows will be a function of how those loans which the SPE bought, for example, credit card receivables, are serviced by the clients of the bank. So if over here you've got some borrowers who borrowed money and owe money to the bank because they made purchases via credit cards or in some other ways borrowed money short term from the bank, as those people are repaying their loans together with interest and principal, that money will be channeled down to the investors who bought asset-backed commercial paper. Now, typically what will also happen is, because there is a risk that these guys at the top, these borrowers, will not be able to repay everything, investors will often require, let's say typically, not always, typically require a backup credit facility to be in place from the bank to the SPV. So, just in case the flows are not happening up here, then the SPV can accordingly utilize a credit line that is set up by the bank to make the promised payments to investors. So the bank is on the hook for, let's say, for the risk, but it doesn't have to itself wait for the borrowers to repay the loans. It gets the money up front because investors buy asset-backed commercial paper. Now, because it's the SPV or the SPE that does the actual issuing of the ABCPs, so the SPE issues the asset-backed commercial paper, in fact, a debt security, that goes on its balance sheet, not the bank's. It's a separate company from the bank. So your book says the bank does not record the liability, the funding. Although, as somebody who trained as an accountant and used to work in the finance function of a bank, I have to warn you, don't take this for granted. Depending on where you are in the world and whether the bank uses these accounting standards or other accounting standards, like, for example, IFRS, it's not so easy for a bank not to record the liability. This is somewhere where I'll be very careful about making very strong statements here. But let's go with what your book says. The bank does not record the liability. Normally, if you issue debt, you have to record the liability in your balance sheet for the funding, because of the funding that you received and you have to pay back. Here, because the argument is it's not the bank that issued the funding, the bonds or the asset-backed commercial paper, it's an SPS, so it's not the bank's liability. Fair enough. I tend to disagree with this, or I would say it's not so easy to avoid this. So it doesn't record the liability on its balance sheet. However, but of course, it receives the cash because it sold the loans, which should therefore disappear from its balance sheet. And and something that we talked about before, if you are no longer in possession of loans that expose you to risk, you can theoretically lower, so the bank lowers its capital requirement. You don't no longer need to hold such a big so-called capital buffer to absorb potential risks that may happen. You've kind of sold or transferred some of that risk to investors who bought asset-backed commercial paper. Lowers its capital requirement. That's the point here. Okay. It doesn't hold the loans anymore on its balance sheet. Those loans get taken out. The only thing that exists is that there is a so far undrawn backup credit facility. Yeah, fair enough. Now, what's the point of this for investors? These investors, they get access to cash flows from the loan portfolio. Think about this like, the credit card portfolio. Normally, they wouldn't have normally, if you're just an investor, you cannot in any way invest into a product that will give you cash flows, which are a function of how somebody is repaying their credit card. And those of you who have credit card debt, you will know, or use credit cards, you know that the interest on credit cards can be huge. So these investors can potentially earn quite a bit because they get a function of what these people are repaying, but they do indeed take the risk of some of those loans never being repaid, because there are delinquencies and there are defaults on credit cards as well, and other types of short-term bank borrowing. So they get access to something which normally would be off limits to them or impossible to get exposure to. Plus, another point is that these types of ABCPs plus ABCPs are typically quite liquid, so they trade in a liquid way in the market, so it's easy to buy and sell them if you no longer want to hold them. Now, I want to stress one thing here. We said that the bank sells short-term loans. Just be aware of the fact that in the run-up to the big 2008 credit crisis, banks used to issue a lot of asset-backed commercial paper, but used to fund not short-term loans with this, but long-term loan exposures, where there was a lot of rollover risk. Because if you've got long-term loans here that are going to generate cash flows over long term, and you're trying to get investors to give you money, but you're promising them, hey, I'll pay you off in the short term, the only way to pay off these initial ABCPs is to issue, after they mature or before they mature, issue fresh asset-backed commercial paper, and from the money received from the with the money you receive from the fresh investors, you pay off the existing ones. So it's like saying, over here we've got a 30-year loan or loan portfolio that's going to generate cash flows, but here you are issuing short-term commercial paper. Well, commercial paper is always short-term, so I didn't really need to say this. Short-term asset-backed commercial paper, which you promise to repay within a year, and the only way you're going to do it, that original loan hasn't been repaid yet, so the only way to give money back to the initial backers, the initial supporters, is to issue fresh stuff and roll the risk over, or refinance essentially. Currently, however, we're back into a more sort of normal situation where ABCPs, so asset-backed commercial paper, which is in itself always short-term, is used only to support or fund short-term loans, which doesn't expose us to the rollover risk. And moreover, those short-term loans tend to be of high quality anyway, so things are much more safe than they were for a time.